Two people can make the same $100,000, buy the same truck, and one of them ends the year with tens of thousands more money left over. Not because they cheated, not because they got lucky, but because the tax code rewards one type of income and punishes the other. And this is the part most schools never taught you. You cannot tax hack a salary if you want to pay less tax legally. You have to change how you earn money, from W-2 wages to business income and equity. Let me show you the simplest example. The tale of two trucks on the left. Hardworking Harry. Harry is a W-2 employee. He earns $100,000 before Harry even touches his money. Taxes get taken out. Federal, state, payroll taxes, the whole stack. Exact numbers depend on where you live and your situation. But let's use a clean example. Harry pays $25,000 in taxes first. Now Harry has $75,000 left. Harry buys a $50,000 Ford Raptor with after-tax dollars, so Harry's remaining cash, about $25,000. Now on the right, business owner Bob. Bob also earns $100,000, but the money flows through a business. Bob buys the same $50,000 Raptor through the business. Assuming it is legitimately used for business and documented correctly. Now Bob has $50,000 left as profit. Bob pays tax only on what is left over, so depending on his real tax rate, deductions, and situation, Bob might keep something like $40,000 instead of $25,000. Same income, same truck, different outcome. Harry looks at Bob and thinks, that is unfair. Bob is not cheating. Bob is reading the instruction manual, and here is the school line nobody says out loud. Your parents taught you to work hard. School taught you to get a good job. Neither one told you that working a job is one of the most highly taxed activities in the United States. You can get an A+ on the report card and still lose 30% of your paycheck before it ever hits your account. Today, I'm going to break down how the rich legally reduce taxes. Using 3 concepts. 1. The tax waterfall, how employees are taxed versus businesses. 2. The famous heavy vehicle deduction concept people call the G-Wagon loophole. 3. The billionaire strategy called buy, borrow, die. Quick disclaimer, this is education, not tax advice. Tax rules change. Limits and requirements matter. If you act on anything discussed, talk to a qualified tax professional, keep clean records, and only deduct legitimate business expenses. The goal is to understand the system, not to play games with it. Now let's talk about the real game. There are basically 2 different money flows in America. Employees live in earn, tax, spend. Business owners and many investors live in earn, spend, tax. That one change flips everything. If you are a W-2 employee, the government gets paid first. Your paycheck is like a conveyor belt. Your money comes down the belt, and a government hand takes a slice before it ever reaches you. You have almost zero control over timing and categorization. You can optimize a little. Retirement accounts, HSA, maybe some credits, but the core system is still tax first. You are a VIP guest at the government's buffet, and they eat off your plate before you even get a fork. Now the business waterfall. A business earns money, then spends money on legitimate business expenses, and then pays tax on what is left. That order matters, because if you can reduce taxable profit legally, you can reduce taxes legally. This is why you hear phrases like business dinner and business trip. Sometimes people abuse it, sure, but the legitimate version is real. If a cost is ordinary and necessary for the business, it can be deductible under the rules. Important reality check. Deductions are not free money. Spending $1 to save 30 cents is still spending $1. The point is not to buy random stuff and call it a write-off. The point is that businesses have a different set of allowable deductions than employees, and that changes the outcome. Now, before we even touch the loopholes, here is the main takeaway you need. You cannot tax hack a salary if all your income is W-2 wages. You are playing in the most taxed lane. To meaningfully reduce taxes over time, you have to change the type of income you earn, from wages to business profit and equity growth, not overnight, not recklessly, but intentionally. Now let's talk about the first flashy one, the G-Wagon loophole. You have seen it, real estate agents, influencers, business owners. Suddenly everyone has a G-Wagon or a huge SUV. Sometimes it is ego, but often it is taxes. In the U.S. tax code, there are rules including Section 179 and bonus depreciation rules that can allow businesses to deduct certain equipment purchases faster, sometimes even in the year of purchase, instead of slowly over many years. And in some cases, that includes certain vehicles, especially heavier vehicles, if they qualify and are used for business. The famous detail people repeat is the 6,000-pound threshold. More accurately, the gross vehicle weight rating over 6,000 pounds for certain vehicles. That is why you hear lists thrown around. G-Wagon, Range Rover, big trucks, large SUVs, some larger EVs depending on configuration. And that is why people say the government subsidizes their luxury car. But let's clean this up. This is not buy a heavy SUV and it becomes tax-free. To legitimately deduct a vehicle, you generally need real business use. You need to track business versus personal use, and you need documentation. Also, the exact amount you can deduct, the timing, and the limits depend on the current year's rules, the type of vehicle, the business use percentage, and other restrictions. Bonus depreciation rules, for example, have changed and can phase down. So think of it like this: if you have legitimate business income, and you buy a qualifying vehicle that is legitimately used for the business, the deduction can reduce taxable income, which can reduce your tax bill. That is the real mechanism. It is not a cheat code. It is how the code is written. Now, why would the government allow this? Because the tax code is designed to encourage business spending and production, not just wage earning. They want businesses buying equipment, expanding operations, employing people, producing output, whether you like that or not. That is the incentive structure. Common mistake. People hear G-Wagon write-off and think it means you should buy a car you cannot afford. If you buy a $120,000 SUV to save $30,000 in taxes, you still spent $90,000. That is not a win. That is an expensive coping mechanism. Deductions do not turn bad purchases into good ones. They just change the price slightly. Now the second strategy is less flashy but arguably more powerful: depreciation. The phantom expense. Depreciation is one of the strangest concepts in the tax code because it lets you deduct a loss on paper, even if the asset is going up in value. Real estate is the classic example. If you buy a rental property, the IRS allows you, under certain rules, to depreciate the building over time, as if it is slowly wearing out. For residential rentals in the U.S., the common depreciation schedule is 27 years. So every year you get a depreciation expense, even if the market value of the property is rising. This is why a real estate investor can have a year where they collect rent. They have real cash flow, but their tax return shows little profit, or sometimes even a loss. Let's do a clean illustration. Imagine a rental produces $10,000 in cash flow after expenses, but depreciation on paper is $10,000. Now taxable profit can appear to be zero. Cash in pocket. Zero taxable profit. That can be legal. That is depreciation. Now, important reality check. Real estate is not a cheat code either. You can have vacancies, repairs, bad tenants, unexpected costs, rising insurance, higher interest rates. Also, when you sell, depreciation recapture and capital gains rules can apply. This is not free money. But the mechanism explains why asset owners can look poor on paper, while cash flows. Common mistake. People think taxes are based on cash flow. Often they are based on taxable income, and taxable income can be reduced by non-cash expenses like depreciation. This is why rich people do not just chase income. They chase assets. Now let's talk about the billionaire-level strategy. Buy, borrow, die. This is how someone with massive assets can appear to pay shockingly low taxes relative to their wealth. Step 1. Buy assets that grow, stocks, real estate, businesses. Step 2. Borrow. When you need cash, do not sell the asset. Selling triggers a taxable event in many cases, like capital gains. Instead, borrow against the asset. A loan is generally not treated as income because it has to be paid back, so it is typically not taxed like income, so you can access cash without triggering a sale. Then step 3. Die. Under current U.S. law, many assets can receive a step-up in basis at death, meaning the cost basis resets to the market value at that time, for heirs in many situations. So the appreciation during the original owner's lifetime can become much less taxable when heirs sell, depending on the asset and the law at that time. The heirs can sell assets, pay off the loans, and the family effectively converted growth into spending power with minimal realized taxable gain compared to selling during life. This is why you hear headlines like, "A billionaire pays less tax than an employee." The employee lives on wages, which are taxed immediately and heavily. The billionaire lives on equity growth and borrowing is not taxed like wages. Now, a serious warning: this strategy has risk. Borrowing against assets can explode if asset values drop, interest rates rise, or lenders tighten terms. It is not a toy. It is a tool used by people with massive buffers and sophisticated management. But again, the point of this video is to show you the system. The rich are not always hiding money. They are choosing income types the code treats gently, and they are avoiding taxable events by structuring how they access cash. Now we hit the hard truth. If you are a pure W-2 employee, you cannot do most of this in the way you are imagining. If you go to HR and ask to use Section 179 on your personal Honda Civic, they will stare at you if you try to deduct your normal life as business expenses. That is not a strategy. That is how audits happen. And if you try buy, borrow, die with no assets, there is nothing to borrow against. So what is the real solution for a normal person? You do not need to quit your job tomorrow, but you do need to start shifting your income mix. You need a path from W-2 only to W-2 plus something. That something can be small at first: a real side hustle, freelance work, consulting, reselling, a service business, content, a small online business, not because an LLC is magic, but because real business activity creates access to the business tax framework, where certain expenses can be deductible and profit can be structured differently. One more important point: you do not start a business to write off your life. You start a business to produce profit. The deductions exist to tax business profit more accurately, not to fund your personal lifestyle. But yes, even a small business can be the first key that unlocks the earn, spend, tax waterfall, instead of earn, tax, spend. So let's recap the full picture. Employees live in earn, tax, spend. Businesses often live in earn, spend, tax. The heavy vehicle deduction concept exists because the tax code can allow accelerated deductions on qualifying business equipment, including certain heavy vehicles when used correctly and documented. Depreciation is a phantom expense that can reduce taxable income even while cash flows in. And buy, borrow, die is the ultra-wealthy method of living on loans backed by appreciating assets, often paired with step-up rules at death under current law. Final thought: the system is not broken. It is working exactly as designed. It is designed to reward producers and owners, and tax consumers and employees. So the real question is, which side are you building toward? If you are tired of losing a huge chunk of your paycheck before you even touch it, subscribe. The goal is not to avoid taxes. The goal is to legally change how you earn money over time. So you stop playing the game on hard mode and tell me in the comments which one describes you right now: W-2 or business, or a mix of both.